Today we cover fair value net asset. Okay, as I mentioned to you, under IFRS 3, mention all assets and liabilities, for subsidiaries must be measured at fair value when doing consolidate. If you want to do consolidate, so all the subsidiaries must be measured at the fair value. I give a scenario here now. I am informed, I have mentioned to you, okay, this is parent, this is sub, equals to group. Group is considered a single entity. When you do consolidate, we assume that this is a single entity. So when you do a consolidate example, so initially, if the subsidiaries use a cost model, example, okay, so PPE, I give an example of individual of SOSP, PPE, 1,000. Just an example, this is only an example to make you understand before I proceed the FVNA, fair value net asset, 500. Yes, 1,000 you plus with 500 in the group statement will be 1,500. But you have to remember, because using a cost model, as I mentioned to you, when you want to do consolidate, all assets and liabilities must be measured at fair value. You see, at fair value. So once you have measured at the fair value, you realize the value will be 1,300. The fair value of the land or buildings up to them. Alright, so fair value is 1,300. So you have an additional of what? Good. So you can say that not enough of 800. So you can plus with 800 in the group statement. So this can put under, if you learn the consolidate video I shared to you, the for pro forma, the format is under working 2 as well. Fair value adjustment, because you have to adjust an additional of 800. Alright, I give an example. If land, you just plus with the 800 as I mentioned here. However, if the scenario is like a building, and building have a remaining useful life of 10 years example, so what you will do? Correct. So from the additional of this 800, you must minus with the depreciation, and this depreciation only charged to group statement only. Okay, so how to get the depreciation? As you can see, under working 2 fair value adjustment, remember, if you remember the format, I will explain after this. So 10 years, 800 divided by 10, 80 per year. So based on when you acquired the subsidiary, so if you acquired at the early of the year, so you minus with, and in the first year you minus 80. In the second year we will minus 160 because this is SOFP. But in the SOPL you must only charge 80. This 80 for SOPL, but for SOFP, for under fair value adjustment, you must minus from the date of acquisition until the year end, regardless of 2 years or 3 years and so on. Okay, so I just recall you the format of working 2 fair value adjustment, fair value, then you got movement, and then you got your year end that you will add into your SOFP just now. So yes, it's now PPE. I give an example, building. Okay, building, you realize the fair value is different, so you have an additional of 800. And this movement, you have to remember, this movement is come from date of acquisition until year end, regardless of 2 years, 3 years. So in the first year only minus 80. If I give an example, just an example. Now you are doing an example of year 2. What you will do? Alright, you acquired at the beginning of the year. Now you are in the year 2. So you will be minus with, good, 160. Because per year is 80, the depreciation. So the balance will be 640. So that 640, you will add here. That means 500 we plus with 640. Also can. They are students, they don't have to do the working too. They just add that plus 800, then minus the whole depreciation 160. You get the same answer. So the best is for me, because at the end in SVR you need to open a full set. You have to show the working. So you get 640. However, but don't forget, careless mistake, although the depreciation is 160 for 2 years, okay, once enter into the SOPL for year 2, group SOPL, I repeat, group SOPL, because depreciation will only charge the group SOPL, because the additional of 800 only appear at the group statement, the additional of 800 value, because of fair value. So SOPL only 80 per year. So this figure, 160 as well, the 160, the whole depreciation for that 2 years, we will enter under working 5, return earning. Your return earning will reduce. Which column? Based on the subsidiaries itself. Okay, we reduce the return earning of the subsidiaries because that depreciation is under is owned by subsidiaries. So we reduce the return earning, group return earning. Okay, so we reduce the return earning working under SM column. Okay, so you minus overall because RE is under good SOFP. That's why you can minus the whole 160. Only SOPL you charge based on that particular year. So for goodwill, where you want to put it, the fair value adjustment, just to recall you, consideration transfer plus NCI, then minus fair value net asset. Under fair value net asset, if you can, under fair value net asset, so I want to recall you what is fair value net asset first. Okay, forget to inform that. Fair value net asset. What I mean fair value net asset is your asset, total asset minus total liabilities. Okay, I should explain this first actually. Alright, I'm so sorry on that. So, fair total asset minus total liabilities. As you can see now, what is another term you call? Good. Total asset minus total liabilities. You get a total equity. That's why, if you realize, fair value net asset can use the formula of total equity as well. But remember, this total asset and total liabilities is a subsidiaries. Right? This fair value net asset in the working tree that you see, in the goodwill calculation, will be a fair value net asset of your subsidiaries. You see, fair value. So you have to remember, maybe the total equity, potentially you can say that the total equity initially is based on the individual statement. Individual statement of total equity. That means total asset minus with all the total liabilities, then you get your total equity. Then what I can see here now, this total equity does not include the adjustment yet, the fair value, as I mentioned just now. So that's why, if you can refer here, I use what in my my working tree, share capital, because it's the same, total equity is the same, because it comes from total asset and minus total liabilities, you get a total equity. But initially, your total equity is not at the fair value, it's measured at the cost model. So share capital plus RE, because still under equity, at the acquisition date, plus OCE at acquisition date. How to get all this? As I mentioned to you in your working one. So this is the total equity, as you can see, but it is not, that is before adjustment. net asset before adjustment. So what you want to adjust, because just now I mentioned got additional of 800. Remember I use the example. So you have to plus with any fair value adjustment. So just now I give an example, the fair value will include equity. This is net asset before adjustment. So your net asset will increase because the value of the building is higher 800. So 800. Remember I mentioned to you, we got other fair value adjustment as well. Why? Possible, maybe all this does not appear. All this does not appear in the individual. Building appear, but at the level of cost. The additional 800 does not appear in the individual. So because it does not appear, so you want to measure it as fair value, so you have to increase as well the net asset. If liabilities as well, if you want to measure the liabilities, before this no liabilities, because of consolidate you have to create the liabilities because of the fair value, so the net asset will be reduced as well. So okay, I want to recall here, asset will increase if liabilities, your fair value net asset have to be reduced. Okay, net asset will be reduced. If asset increase, net asset will increase. Liabilities increase, your net asset will be reduced. So what is another principle here? I give an example. What is a fair value adjustment? Other fair value adjustment that can be in the fair value net asset. Okay, after you adjust that. So first I mentioned to you the PPE just now, either land or building. But remember, initial you create at where class? Okay, initial you will amend your goodwill, will affect your goodwill calculation. You put under your alright, working 3. And if FAK, so working 2, under this working 2 you will see the subsequent as well, movement, alright, from that particular, such as depreciation and so on. And don't forget the presentation, SOST also need to be added in the working 2. So in my second part now, intangible asset. Why intangible asset is also will increase your fair value net asset? As I mentioned to you just now, they are not appear in the individual. You see, does not appear in the individual. So it's not include the net asset. That's not included yet. So you have to include it. The net asset will increase. Why? Good. Because I give an example. Any internally generated cannot be capitalized. IAS 38. Any internally generated cannot be capitalized in the individual statement. So what I want to say here now, possible, I give an example to you, like brand. Subsidiaries have their own brand. I want you to write subsidiaries have their own brand. Customer list of the subsidiaries, all does not appear in the individual. But due to IFRS 3, combination, business combination, due to business combination, these two amounts can be capitalized in the group statement. Capitalized in group statement. So therefore, what I can say here now, due to you can capitalize in the group statement, your fair value net asset also will increase initially. Initial fair value net asset will increase under working 3, goodwill. Okay, I'm using like this. I'm explaining like this for intangible asset. So next, beside goodwill, you have to increase the fair value net asset because you just capitalize it. In the individual does not appear net asset before adjustment. So now your net asset increase because you can capitalize it. So next, working 2, the subsequent. Can I know the subsequent? Good. Intangible asset, amortized cost. This amortized cost use the same principle as depreciation. That means you charge to W5, RE, and then we charge to your SOPL per year. So you have to calculate the amortized cost. And the intangible asset for presentation will appear as well. Maybe when you plus, I give an example from the first example. In your SOFP, you does not see any IA, zero. But in the group statement, then you can see the IA, the net carrying amount after minus the amortized cost. How much is it? You see, in the group statement can appear the IA. Individual, no IA. So you must add up. So how you want to know the value that come here? It come from working two. So that is intangible. Alright, number 3. Contingent liabilities. This is not talking about liabilities. Okay, IS 37 talk about individual. As I mentioned to you, although group, you must mention about both individual and group. In individual, what you will do if contingent liabilities only? Good, you will disclosure needed. So that means no recognition. So what I can say here now, under these liabilities, there are no contingent liabilities, zero. You does not recognize it because in the disclosure notes. Under disclosure notes. However, when it comes to a group statement, you are allowed to recognize it under liabilities, the contingent liabilities. How to get the figure is the same step, class. So, group measure at fair value if the amount reliably, okay, if the amount can reliably, so you can recognize it in the group statement as a liability. Class, just want to share to you, when you talk about liabilities in the group statement, what happened to your fair value net asset? Reduce. Good. So you have to minus it later because the liabilities. Net asset is asset minus liabilities. So any liabilities will reduce your net asset. So under working 3 goodwill. Alright. Next, working 2. Okay. Because why working 2? You want to know your presentation. How much you want to put under your SOFP. There are no movement here. No subsequent. No subsequent. That means the amount will be the same as initial and year end as well. What I mean year end, sorry to inform you, yeah, this is year end. I recall it, alright. So this is an initial at DOA, date of acquisition. So this period is from the first beginning you acquired, regardless of how many years, 3 years or 4 years. This is year end that the question required you to do. Question required. When of the year end of your statement. So PPE, you have intangible asset, you have a contingent liabilities. So next, we will be having a deferred tax. So under this deferred tax, I will share to you from another video, deferred tax on group financial statement. So I will cover all deferred tax on group statement in my another video. So today I just want to share to you why you have this fair value adjustment. It is because of you have to measure at the fair value for PPE and building, and because of that fair value, any changes in the carrying amount in your group statement, you have a movement of depreciation subsequent. Intangible asset, before this cannot recognize, but because of group statement you can recognize. Contingent liabilities, before this in the individual statement you disclose, but now when it comes to group, you are allowed to recognize it if the amount can be reliably, amount can be measured reliably, measured at the fair value, and we reduce your fair value net asset. So I want you to talk about the impact actually, alright? I want you to talk about the impact. This is for number 3, contingent liability story. Deferred tax, I will cover this later in my other video. So this is roughly about fair value net asset. So you have to amend the fair value net asset. Sometimes the question will give you the amount of the fair value net asset. Example, the fair value net asset is 2,000. Then you realize that 2,000 does not include the intangible asset yet. Does not include the contingent liabilities yet. So you have to amend the fair value net asset in calculating the goodwill. You see, that means not only building, you can add more intangible asset, contingent liabilities. This is have to be reduced, don't plus, minus, then any deferred tax. I will explain this later. Then you can get your total fair value net asset. This is only story about fair value net asset. Once you get your fair value net asset, then you will plus your NCI and your contingent transfer to get your goodwill at DOA, date of acquisition. So remember, when you're explaining the essay, you must explain one by one. If you meet the issue of intangible, if you meet the issue of contingent, so separate the heading. Talk about intangible asset first. Talk about contingent liabilities. Then you talk about NCI and NCT. Because every item in the goodwill, you have to have an explanation. It depends on the requirement of the question and the case study as well. Alright, that's all for fair value net asset. I will add more principle in the future, with a lot of principle under this fair value net asset. But for now, you just get the basic first, which is, you know what is fair value net asset. I want you to summarize, please. Please write. Okay, the summarize is, first, you need to know this. What is fair value net asset? It's an asset minus liabilities of the subsidiaries. Then you get your total equity. Initially, your total equity before any adjustment of the fair value. It comes from the individual statement originally. Alright? Then you have to amend. You have to add more. Net asset will increase once you capitalize all the item that I have shared to you, all these four. PPE, intangible, contingent. This will affect your current fair value net asset. So you have to get the latest fair value net asset before you calculate the goodwill. So please understand the principle, because if you write the principle, measure at the fair value, all this, you can get marks. You talk about individual, you talk about charge to SOPL, you talk about charge to reduce your charge to RE, you can reduce your RE or increase your RE, and so on. So only deferred tax I will cover in my other video. That's all for today. And remember, deferred tax will also inside the fair value adjustment as well. Why deferred tax? I can mention to you. Remember, I mentioned PPE, you got gain of 800, right? So when you learn another video later, you will realize the gain also will incur a tax, incurred deferred tax on the gain. So how to calculate the deferred tax on the gain, I will cover in my next video. So therefore, we will create a DTL if gain. So this DTL, deferred tax, only appear on the group statement. This deferred tax does not appear in the individual statement of the subsidiaries. So I want to teach you what is the impact of deferred tax towards the fair value adjustment, or we can say fair value net asset when you're calculating the goodwill. So all this, 1, 2, 3, 4, only appear in the group statement. Recognition in the group statement. Alright? So that's all for today. Thank you.